Welcome now, Bloomberg Economics' Tom Orlik coming to us from Washington. Bloomberg Economics is out with a new report this morning on the economic costs of the trade war. Still with us is Sarah Hunt of Alpine Woods. So, Tom, let's start with you. Do you agree with Laurence?
I think we're broadly on the same page here. We ran various different trade scenarios through our model of the global economy to try and get a sense of how big the costs could be and where could they fall. Our base case is now that we stick with the 25% U.S. tariffs on the $250 billion of Chinese imports, plus the Chinese retaliation that's already been announced. On that scenario, we would see global output, global GDP, down by about 0.3% in 2021 relative to the baseline of no trade war. Now, if Trump follows through on his threat of tariffs on all Chinese imports, that amplifies the impact. In that scenario, we'd be looking at global output down by 0.6%, and that's about $600 billion.
Okay, that's substantial. How do you trade binary risk like this?
It's very difficult. The equity markets don't seem to think that that risk is right there now, given the fact that we're less than 5% off the highs that we just hit a couple of weeks ago. So I think that the market is assuming that we're going to get something done here. If you don't, I think that you have some real risk in the equity markets, but you also still have very low interest rates globally. You have some knock-on effects. I mean, it's hard to say what GDP output is. You have some knock-on effects with, am I going to put a factory here? Am I going to make these investments? Am I going to wait until we sort out what's happening? So I think that you have a slowing effect, even if you don't get all of this, just because you have people indecisive about what to do and where to put things, given what's going on right now.
Sarah, it's also sort of a reverse wealth effect in the case that if we start to get a slowdown, you're going to hit the equity markets as well.
I would think so. I mean, you look at the fact that you've had this incredible growth from the fourth quarter where everybody was worried about things. The market made new highs in May, and now all of a sudden you're looking at some output an outlook that isn't that clear. And luckily for the U.S., earnings have been pretty good, and they look like they're going to stay pretty good unless this actually escalates very quickly. I think you've got some time for this, but I think that definitely there's a risk out there.
Hey, Tom, do you feel like central bankers, world governments are prepared for the kind of scenarios that you've modeled here?
So the assumption in our modeling is that central banks have a neutral response. They don't respond to higher inflation by hiking rates. They don't respond to slower growth by cutting. Of course, the more realistic scenario, thinking about what the Fed and the PBOC have in terms of options, is that if we do start seeing growth crumbling, then we would see both the Fed and the People's Bank of China responding with some kind of policy stimulus. Now, globally, when we look at central banks around the world, there's not a lot of policy space. In China and the US, there is still a little bit of wiggle room. So if we do start seeing tariffs going up further, if we do start seeing investment, consumption responding to that by coming down, our expectation is both the Fed and the PBOC would have a little bit of space to offset that.